So, what is an LLC and how does it work? This is the only video you need to learn everything there is to know about LLCs. It's a free course with live demonstrations just for you that will cover exactly what an LLC is, how to form an LLC, how to fund an LLC using business credit and credit cards, the finances of an LLC, including write-offs, paying yourself, and taxes. And here's my promise to you. By the end of this, you will have a solid system for creating and maintaining an LLC. Hope you enjoyed the compilation. Let's get into it. So, what is an LLC? Let's start there. LLC stands for Limited Liability Company. It's a legal structure for your business, a way to organize how your business exists in the eyes of the law. And the phrase limited liability is the whole point of the structure here. It means that your personal life and your business life are separate. If you start a business without an LLC, legally, you are the business. So if the business gets sued, you get sued. If the business owes money, you owe money. But if you form an LLC, the law draws a line between you and the business. You see, business debts belong to the business. Business lawsuits target the business. Your house, your car, and personal bank account are usually off limits. So the first step is to choose the right state, okay? Where you file impacts a lot of things: your taxes, your privacy, and your costs. Now, the default for most people is to file in your home state, okay? This is simple. It avoids extra fees. And once again, it's the best option for most people. Now, when should you file in a different state other than your home state? Well, it's when you want to keep your privacy, right? So people can't find out who you are, or you have many investors, all right? If that's the case, then you might want to look into Delaware, Nevada, Wyoming, right? These are popular places for that privacy and for investors, okay? If you have investors in your LLC. All right, so step 2, you want to select and lock in your name, okay? So your LLC name must be unique, compliant, and available, right? That's the 3 criteria: unique, compliant, and available. So when you go to set this up, you must include LLC or limited liability company in your name. Another thing to note is that you cannot copy another name in your state's database. All right, that's key. It has to be unique. It can be slightly different, right? But still unique. You can't just copy. And here's a pro tip. You want to check matching domains, search engines, and trademarks early to avoid those rebranding costs. Okay, that's going to be very important. You don't want to choose a name that you fall in love with and then later go and check the social media handles, the domains, right? Search engines, and find out someone is already dominating that exact name. Easy enough, right? Let's move on to step 3. This is appointing a registered agent. So your agent is basically your legal mailbox, right? So you don't want to overlook this. And Karan, what does that mean? Well, any mail, right, that comes from the government, very important documents, will be sent to that agent, all right, on file. And also all the spam, all the spam that comes with starting a business, starting an LLC, you'll see, that comes in the mail will be sent to this address, right? So it can be you, right? But if it is you and you choose to use your home address, then that home address will be public information. Okay, so you might want to avoid using your home address if you decide to be your own agent, right? But if you use a company, there are many services out there for registered agents. It's between $50 and $150 a year to do so. But if you go that route, it protects your privacy and it handles all official notices from the government, okay? And here's a novel insight. If you ever expand to different states with your LLC, one agent service can cover them all, okay? So that's just something to note. But say you want to be the agent, you don't want to hire or pay for another service to do it, then go ahead and get you a mailbox, right? I say UPS, USPS, so on and so forth. And then you can use that address, right, for this purpose here. Okay. All right. So let's go into more about choosing your address here. Right. So you want to choose a professional business address if you don't go that route with the agent. All right. So your address affects credibility, privacy, and funding. So once again, using your home address is public record, right? So it can lead to that spam email that I was discussing earlier. So once again, get a mailbox at UPS or USPS for this purpose, right? And lenders actually sometimes auto flag home addresses as higher risk, right? Because your home address might just show that you are less serious of a business, okay? And also another novel insight here is that some grants, right, and contracts require a non-residential address anyway. So save yourself the privacy, right? And save yourself the future headache with getting funding and dealing with other contract situations, and just get a mailbox somewhere else or use a registered agent. Okay. Now, let's go into the actual filing of this LLC. And this is basically you filing your articles of organization, all right, which is basically like the birth certificate of your LLC. So how do you do this? Well, you file with your state's Secretary of State. All right, this can be online. So you just go online, type in LLC in your state, right? And you'll see your state's website to actually create an LLC. All right, most people do this online. Now, there are some info that is actually required when you go to do this online. You're going to need your LLC name that you picked out, your address, your agent, and sometimes if it's a multi-member LLC, the other members of the LLC, right? You're going to need their information as well. And then you just simply pay a fee, right? It's between $50 and $500 depending on your state. And ladies and gentlemen, that's how you set up an LLC, okay? All right, at least the filing part of it, that's how easy it is. And this is all someone is going to do when you go to pay them to do it. Takes 5 minutes. You can do it yourself, okay? Let's move on to step 5. Now, step number 5 is drafting an operating agreement. And skipping this step here is the number one future lawsuit trigger. Okay? Why? Because your operating agreement defines the ownership, the profit splits, and the decision making of your LLC, especially if you have other members in it. This is going to be huge. And even if you don't, it's huge. Okay. And this operating agreement is actually required in some states, right? But it's actually smart to do it in every state. Okay. The first step is to go to lawdepot.com. I'll leave a link for it in the description below so you don't got to go searching for it. Then you want to go to business at the top and then LLC operating agreement. All right. So we're going to start creating the LLC operating agreement. Note that it asks you, where is this company registered? And that's because it's going to want to create an LLC operating agreement that is specific to your state. So for me, I'm going to leave it on Georgia. Then I'm going to go to save and continue. Next is going to ask you, will your company perform professional services? So if your company performs a service such as cleaning, right, then you're going to want to click yes. If you are just, say, an e-commerce business, then you would click no. For me, I'm going to click no. All right, and then it's going to ask you, what is the primary purpose for this company? Now, for my company, Karan's Toys, you can make something general and something broad typically works, okay? So I'm just going to say I sell toys. Next is going to ask you for your company name. So go ahead and put your company name there. Then, where's the company principal office located? Okay, so wherever your company is located, if you have an office, then you put the office address. If you work from your home, then you put your home address. All right, so it's asking for the street. All right, so you put your address in. Now, save and continue. Okay, next is going to ask you, will this company have more than one class of members? So in an LLC, your members are the owners. And when it asks you if you want to have more than one class of members, more than one class of owners, it's asking you if you want to have different, say, subsections of owners. each having their own different rights and responsibilities and obligations. That is up to you if you like to do that. For me and Karan's Toys, I'm going to say no. All right, next is going to ask you who are the members, aka the owners of the LLC. Note that with the LLC, you can have different types of owners. You can have actual people or individuals. A corporation can own an LLC, and then you can have a partnership, trust, or another LLC can own the LLC. So for me, I'm going to say individual. And all right, so I am one of the owners, right? So go ahead and put your name there, or I'm going to go ahead and put my name. And you can put your address if you like. If you have more than one member for your LLC, so say you're a multi-member LLC, right, not a single member, then go ahead and add all of the members. And my partner's name is John Doe, all right, in Karan's Toys. So you have your members, and you want to go down and click Save and Continue. Now, a capital contribution is anything that a member contributed to getting the business started. Now, note, this can be money, this can be time, this can be things such as equipment, right? Whatever you contributed, whatever a member contributed to get the business started, you place it here. So me, I contributed, say, $5,000 in cash, right? And you want to put a total value here of $5,000. And my partner, John Doe, contributed equipment with a total value contribution of, say, $5,000. All right, so once again, capital contributions are anything that you contributed to getting the business up and running. All right, once you have that in there, click Save and Continue. So next question, could additional contributions be required in the future? Well, what does that mean? Well, we can go over here to the frequently asked questions and figure out, right? So choosing yes means that members can vote to increase the overall level of capital contributions in line with business needs and require additional investments from its members. So if you say yes, then you are basically saying that if the business needs more money, right? If you vote to increase the capital contributions, then basically they're required to, right? Your members are required to fulfill that obligation. If we choose no, then let's see what it means. Choosing no means any additional money invested in the company by a member, aka owner, is treated as a debt owed by the company to the owner. This means that members' original share in profit and loss and in distribution will be maintained. So this does not affect equity, but is basically seen as almost like a loan to the business from one of the members. Okay, so I'm going to click no. Now we're going to get into if you're able to add new members to the LLC. All right, can a new member be admitted later? I'm going to say no. All right, this is up to you, but I'm going to go ahead and say no. All right, can a member voluntarily withdraw from the company? That is up to you. I personally believe that if you're in business with somebody and you choose to do business with someone, that you can't just voluntarily leave. We're going to have to work it out together or figure out, how to go about that situation. So I'm going to click no. Okay. But if you have any questions about why you should restrict members, then you can look at this frequently asked questions here, and they have a good point. The success of your LLC depends on the participation of all members, right? That's why you might not want to have a member voluntarily withdraw from the company. I agree. All right, let's talk about member meetings. So LLCs are required to hold regular meetings, right, to discuss business. And you can put in your operating agreement how often you will hold regular meetings. Now, I'm going to choose only as required. I don't think that you should place a requirement in your operating agreement on regular meetings, but it might be good if you need to, hold yourself accountable and hold your members accountable, right? Me and Karan's Toys, we've been doing business together, me and John, for years, and I think we have a good understanding of when we need to hold meetings. So I'm going to use only as required, but if you need to hold yourself or your members accountable, then go ahead and put it in the operating agreement so that you can reference it later. Next, how will member votes be determined? Okay, by ownership share, or will everybody have equal vote for each member? Let's talk about this. So you can you can decide how voting, right? So when you need to decide on something, how votes are determined. It can be by ownership share, or does every single person in the LLC have an equal vote? I'm going to choose equal vote for each member. If you have a LLC where you might, different people have varying ranges of ownership in the company, then you might want to click by ownership share, right? Because someone that has 1% ownership might not or should not have the same say so as someone with 70% ownership, right? But me and John, we have equal share in the business, so I'm going to do equal vote for each member. Next, let's go over to management details. So the next question goes into management, and it asks you who will manage the company. Two options, the members or one or more appointed managers. So within an LLC, it can be member managed, meaning the owners of the business run and operate the business on a daily basis, or it can be manager member, meaning that one or more appointed managers, not the owners, manage the business on a day-to-day basis. Okay, so with the first option, the owners of the business are actively working in the business. And in option number 2, the owners of the business are passively in the business. They do not work on a day-to-day basis. So I'm going to choose the members, or AKA the owners, will manage the company, as me and John plan to run the company and grow the company together and work in it day to day. Right, now let's go into accounting. So it asks the question, how should this company be classified for tax purposes? Will you be taxed as a partnership or a corporation? Okay, now I won't go into what this means. We have videos on our YouTube channel that can help you decide which is best for you. But I'm going to go ahead and say that we will be taxed as a corporation. Okay. Now I ask the question, do you wish to include your fiscal year end? And I'm going to say yes. For your business, your corporation, when does your fiscal year end for the company? And for my company, it ends December 31st. Okay, that's the end of our fiscal year. Next, let's go into profit allocation. So how will profits be allocated? And there are 3 options here. Each member will receive an equal share. Okay, each member will receive a fixed percentage, or each member is allocated profits based on their capital contributions. All right, so you have a decision here to make. With the first one, each member receives an equal share regardless of their equity percentage. Next, each member will receive a fixed percentage so that can match their equity percentage. And next, in proportion to capital contributions, aka what you actually contributed to the business. I'm going to go with in proportion to capital contributions. Okay, just meaning that what we brought to the business is our share of the profits and what should be allocated. In addition, how I plan to operate my company with John is that every hour that you put into the business grows your contribution pool. Okay, so that's how I want to do it. So I'm going to click the third one. Next, let's go into annual reporting. In addition to federal income tax reports, what other reports do you want to include in your annual report to members? Okay, you have income sheet, balance sheet, cash flow statements, profit and loss summary. These are, accounting documents that should be happening on a monthly basis, honestly, for every single business out there. So I'm going to include all of these as a requirement because I believe that it's important. Okay. All right, now we're going into dissolving the company, right? So will the company be dissolved if one member leaves? All right, so if a member leaves, whether they're voted out or so on and so forth, will the company dissolve? That is something that you have to, think about for yourself. I'm going to go ahead and say no. If John leaves for whatever reason, then the company will not dissolve. But how will assets be distributed when a member leaves or when winding up the company? 3 options, similar to profit and loss. Each member will receive an equal share. Each member will receive a fixed percentage in proportion to capital contributions. I'm going to go with in proportion to capital contributions. All right. Next, let's go into administration. Who can sign contracts on behalf of the company? any member of the organization or specific groups or individuals. I'm going to go ahead and say any member for me and John, but I want to make sure that you understand that if you click this, any member, regardless of their equity percentage in the business, will be able to sign a contract. If you don't want that to happen, say you may be the only one that can sign on contracts on behalf of the company, then you may want to choose this option. All right, let's go to save and continue. All right, are members allowed to compete with the company? All right, so this is we talking about non-compete clauses. I'm going to go ahead and say no. Right, you can't compete with the company. But how long are members restricted from competing with the company? And I'm going to say for 6 months after leaving. Okay, you can also add other options after leaving the company, right? But I'm going to go ahead and say 6 months after leaving. All right, now let's go into actions that require unanimous consent. So unanimous consent amongst all members. So select the issues that require that. Selling, loaning, mortgaging, or otherwise trading company property, releasing any claim except for payment in full, incurring liabilities over a fixed dollar amount, or incurring expenses over a fixed dollar amount. So I'm going to go ahead and click all of these because I believe, at least in me and John's partnership, that we should unanimously agree on all things that happen with the business. So incurring liabilities over a fixed dollar amount, I'm going to say over $0, and incurring expenses over a fixed dollar amount, I'm going to say $0. Right? So anything over nothing, we have to unanimously agree on. As you can see, this is very thorough and very detailed and will save you from trouble later on. All right, so additional clauses. Do you want to include any additional terms or information? If you do, you say yes, and you can include them here. I'm going to go ahead and say no. But the good news about all of this is that LLC operating agreements, once again, are editable afterwards if all parties agree and sign on it. So this can be a good starting point once again, but it is not a one and done, right? It can be edited. So I'm going to go ahead and say no. Hit save and continue. All right, what is the signing date for this agreement? I'm going to specify a date, and I'm going to go ahead and say today. And will you have witnesses sign this agreement? I'm going to say yes. How cool is that, y'all? So it says to download and print your LLC operating agreement, you must select the free or premium license. Go ahead and select the license. All right, you can go ahead and select free if you want and just get this LLC agreement. If you want to look at some of the other plans, you can. But Law Depot has a ton of other documents that may help you. So consider these options. But I'm going to go ahead and do the free trial. All right, and once you do the free trial, you can go ahead and enter your information, and then you can download that agreement and have your LLC operating agreement. So that's Law Depot. Once again, I'm going to go ahead and put a link in the description for you so that you can get here easily and start your own LLC operating agreement. Step number 6 is applying for your EIN, right? So your EIN is your business's social security number, right? And this is completely free on irs.gov, right? So avoid paying people that charge you to set up your EIN. This takes 2 minutes, right? Don't pay someone to do it. But your EIN is important. Why? Because you need it for taxes, your bank accounts, and for payroll. So make sure you set up your EIN once your articles of organization are filed with your state, right? And it's instant approval online in most cases, right? So not only is it easy, but you also get it instantly. So the first thing you're going to want to do is go to Google and type in something like EIN free. Okay, once that loads, I want you to do something for me. You may have ads at the top. Make sure you skip the ads. Those are going to be sites that are going to want to charge you for nothing, okay? So make sure you're going to the actual site for the IRS. And you'll know because it says irs.gov, okay? And click on that link that says apply for an employer identification number. So now that the website has loaded, the first thing I want you to know is the hours of operation, okay? It's Monday to Friday, 7 a.m. to 10 p.m. And that's important because if you go to this website, say on Saturday or Sunday or after 10 p.m. on the weekday, you won't be able to get your EIN number, okay? You'll have to wait. So note the hours of operation, and then they'll walk through the steps that you'll go through to get an EIN. So step 1, you're going to determine your eligibility. Step 2, you'll understand the online application. And then in step 3, you'll actually submit your application. So let's get started. So you're going to want to scroll down to apply online now. All right, close out of anything like that. It's going to give you some more information, but you want to click begin application. So first thing is to identify yourself, and you're going to do that by choosing your legal structure, the legal structure that is applying for an EIN. So we have some options here. So proprietor, partnerships, corporations, limited liability companies, aka LLCs, estates, and trusts. All right, and there also are a few additional types. So for demonstration purposes, let's go ahead and click limited liability company. Next, you're gonna click continue. So it's just gonna give you some background on the entity that you picked, because they want to make sure you pick the correct one, what it is and what it is not. So if you agree, right, that you're an actual LLC, then you would click continue. Okay, so next, they're going to want you to tell them more information about the members of your LLC. And if I was a sole proprietor, this would be something different. So how many members are in the LLC? Well, if you're a single member LLC, you're going to just put one. If you are a multi-member LLC, then you're going to put how many members, right? How many owners are there of the LLC? So for this purpose, I'm only going to put one. Next, please select the state and territory where the business is physically located. Well, I'm in Georgia, right? And I'm just gonna say that the business was registered in Georgia. So wherever your business is registered and physically located, you're going to want to put it. Now, let's click continue. Now you're just gonna confirm your selection, right? You said that you're a single member LLC and you do not wish to be classified as, say, a S-corp or a corporation, right? So that's true. So let's click continue. Next, why is the LLC requesting an EIN? Why is your business requesting an EIN? Well, there's a couple of options here. We have, you started a new business, you hired employees, you want to sign up for a bank account, you change the type of organization, or you purchase an active business. Remember the questions that I asked early on to decide if you need an EIN, right? You started a business, you hired employees, you changed your type of organization, or another bank purpose. Well, this is exactly that. So what is your reason for requesting an EIN? Well, for me, it's because I started a new business. Let's click continue. So now the IRS wants you to tell them about the responsible party for that LLC, okay? So go ahead and put in your first name, your middle name if you have one, your last name, any suffix, and then your social security number or ITIN. Then it's going to ask you to choose who you are, right? Are you an owner or member of this LLC? Or are you a third party applying for an EIN on behalf of an LLC? So I'm an owner, so I'm going to click that and then go to continue. Okay, so now you're going to want to put in information about where the LLC or your business is physically located. So let's just go ahead and put in some information here. So after you put in the street, the city, the state, the zip code, and the phone number, it's going to ask you if the address above is different where you want mail to be sent. So you're going to hit yes or no. One thing to note on the address, it must be a US address, right? You cannot use a PO box for this. Just a quick note. Click continue. All right. So now it's time to input information about your specific business. First up, the name. Here you can have a trade name or DBA name if you have one. The county it's located in, the state where your articles of organization are filed or will be filed, when that business was started. So once you have all of that information, go ahead and click continue. Then we're going to need a bit more information. Does your business own a highway motor vehicle with a taxable gross weight of 55,000 pounds or more? No. Does your business involve gambling or wagering? No. Does your business need to file Form 720, which is a quarterly federal excess tax return? No. Does your business sell or manufacture alcohol, tobacco, or firearms? Not in this case. And lastly, do you have or do you expect to have any employees who will receive Forms W-2 in the next 12 months? And note that Forms W-2 require additional filings with the IRS. I'm going to click no and click continue. What does your business or organization do? How do you categorize your business? Well, is it an accommodations business, a construction business, a finance business, a food service business? You get it, okay? So my particular business for this example is going to be other, okay? Let's click continue. And now it's going to ask you what type of other, right? Is it consulting, manufacturing, organization, rentals, repairs, sales of goods, services, or other? Well, I'm going to choose consulting. Click continue. And it's going to say, because I've chosen consulting, do you provide operating advice and assistance to businesses and other organizations? I'm going to click yes. And in this, I'm going to put accounting and tax consulting. All right, I'm going to click continue, and there you have it. It's going to ask you, how would you like to receive your EIN confirmation letter? You can receive it online, and if you do receive it online, you will get that EIN instantly, or you can receive it by mail. And by mail, it's going to take up to 4 weeks for delivery, but I've seen it take up to 6 weeks. So if you want your EIN right now, immediately, then receive it online. So then you would just click continue, and then you would receive an EIN number immediately. All right, let's go on to step 6.5. We're not at 7 yet, but at 6.5. And this is one that is paramount. Do not miss this one, right? That is picking a strategic NAICS code. Okay, so your NAICS code shapes how banks and investors view you, right? So the NAICS code, when you go to set up your LLC, is the 6-digit code that defines your industry, right? It impacts loan approval, insurance rates, and eligibility for grants. Get this, you choose the wrong NAICS code, right? Even if it's the one that is most relevant to your business, it can affect you later on down the line. So make sure you realize this, right? Some codes are flagged high risk by lenders, right? So bars, adult services, trucking, real estate, right? While others get easier access to credit. Okay, so avoid those high risk industries. And here's a pro tip: if your business overlaps categories, choose the one that positions you for future funding. All right, don't choose real estate, choose property management, right? As an example. All right, let's move on to step number 7, which is opening a business bank account. So a clean bank account actually protects your liability. All right, so you never want to mix business and personal money. Never do this. Never do this. So when you go to open that business bank account, you're going to want to bring 2 things: your articles of organization and your EIN letter, right, for the bank. And some banks charge fees when you go to open this business bank account, but some are actually cheaper or completely free to do so. Okay. So that's step number 7, is open a business bank account. It's actually really easy. Don't be intimidated by it. Okay. And my top picks are NBKC, Bluevine, and Mercury Business Checking Accounts. You see, each of these banks have their own pros and cons that we'll talk about in a second. But I like these 3 for new and startup businesses because they are low cost and low maintenance, with no monthly fees, no minimum opening deposits, no minimum balance requirements, and are online banks. So enough of that. Now on to the banks. So the NBKC Business Checking Account is a checking account that packs a ton of pros for the great price of $0. As mentioned above, there are no monthly account fees, no minimum balance requirements, and no opening deposit requirement. Additionally, there are 0 incidental fees, which means 0 overdraft fees, 0 stop payment fees, and 0 fees for incoming wires. But with all the mention of 0, they have unlimited transactions. So you can make as many transactions as you would like to without incurring a fee. And they reimburse you up to $12 per month in ATM fees. Now, the NBKC checking account is great, but not perfect. So here are the cons of the NBKC checking account. First, they do not have branches outside of Kansas, and their international wire transfer fees are pretty darn high. But the biggest con, in my opinion, is that they do not integrate with third-party business tools like Stripe or QuickBooks. Even so, NBKC Business Checking is a great option for those who prioritize low fees over integrations. Next in this category is Bluevine Business Checking. Bluevine Business Checking is a special and rare case in this category for 2 main reasons. Yes, they offer no minimum deposits or balance, no monthly service fees, no fees for non-sufficient funds, and unlimited transactions. But Bluevine shines because they offer 1% interest on account balances up to $100,000. The ability to earn interest on your balance is a rarity for this type of business checking account. And you know what's also rare for online banks? The ability to deposit cash, which you can do with the Bluevine checking account. So where does the Bluevine business checking account lack? Well, Bluevine is an online only business checking account, which means you won't have access to any physical branches. And while they do offer the ability to deposit cash, there is a $4.95 fee to do so. And the biggest con I see with Bluevine is that there can only be one user on the account and only one debit card can be issued, which means if you are in a partnership, this may be an issue for you. But with that said, your Bluevine business checking account is great for those who do not need multiple cards, might need to deposit cash, and would like to earn interest on their account balance. Now, at the moment, Bluevine has paused taking applications for their business checking account due to such high demand, but you can still sign up for the waitlist on their site. Now, the last business checking account in this category is the Mercury business checking account. The Mercury checking account is another online only checking account with no monthly fees, transaction fees, or minimum open deposit. Oh, and unlimited transactions, but additional benefits as well. And that's because Mercury provides both the checking and a savings account, allows you to send and receive online payments, create virtual debit card, and customize your banking. And if that wasn't enough, they also offer third-party integrations and multiple debit cards, unlike previously mentioned options. So all of that is fine and dandy, but what are the cons of the Mercury business checking account? Well, sole proprietors are not eligible for the account, and there's no ability to deposit cash. But if you're not a sole proprietor and likely don't need to deposit cash, then the Mercury business checking account is a standout checking account for small businesses. After that, I want you to start building business credit. Business credit is a company's ability to buy something today and pay for it later. By building business credit, you enjoy the following benefits as an LLC: higher limits on business lines of credit and loans, which provides increased purchasing power; utilization freedom, which provides more leverage; no effect whatsoever on your personal credit; better approval chances, terms, and prices, which means cheaper financing in the short term and long term that leaves more money in your business. To start building business credit for your LLC, do the following. Step 1, incorporate your LLC. Step 2, get an EIN, which was the second point in this video on what to do after you start your LLC. Step number 3 is to open a business bank, which was the third point in this video. Step 4 is to get a business phone number. Step number 5 is to register with Dun & Bradstreet to get a DUNS number. You see, Dun & Bradstreet is one of the 3 top business credit bureaus. To get a DUNS number, go to Dun & Bradstreet's website at dnb.com. Click on DUNS number in the menu, then click Get a DUNS number. Easy, right? Step number 6 is to establish trade lines with vendors and suppliers who report. Popular options with net 30 payments include Shirtsy, Uline, and Quill. You could also apply for a business credit card. For the best business credit, be sure to pay your vendors and credit issuers early. Business credit is calculated based on your company's payment history, negative marks, and business information, like how long you've been in business. Business credit cards are not created equal. Some are created specifically for startups and small businesses and are packed with perks, rewards, and easy approvals. Then there are business credit cards that will instantly deny you while hurting your personal credit in the process. So use this video as a guide to find the best credit cards for startups and small businesses. And as a bonus, I've included cards that are 1, actually good, and 2, do not have a personal guarantee, which means your credit won't be affected in the process. Those who watch this video till the end will find a credit card that's right for them, an inch a little bit closer to a credit line for their business. Oh, and by the way, this video is sponsored by my empty wallet. So thank you in advance for liking this video. It helps our channel grow tremendously and also helps us reach more entrepreneurs like you. Okay, enough of the intro. Let's get into the best business credit cards for new businesses and startups. So the Brex credit card allows business owners to get a business credit card without the need for a lengthy application process. The best part, it has no annual fee, no APR, or any personal guarantee. The Brex credit card also offers the ability to get a credit line that's normally 10 to 20 times higher than you would receive from other credit cards. Now, this is rare, but the Brex credit card offers no transaction fees for international purchases, making this card ideal for business owners who travel outside of the United States. Okay, that's good, but what else is great about the Brex card? Well, you earn 10,000 points on your first $1,000 of spend, and an additional 10,000 points once you spend $3,000. And if it couldn't get any better, to top it off, you get an additional 20,000 points when you link your card to your payroll provider. Furthermore, this card comes with unique rewards and rebates to keep you motivated to use it. We're talking 8x on rideshare, 5x on Brex travels, 4x on restaurants, 3x on recurring software you're going to use like QuickBooks, and then 1x on everything else. Sheesh, does it get any better than that? Sounds too good to be true. Luckily for you, it isn't. And all of the points you accumulate aren't boxed into a certain few categories. You can redeem those points for cash, credit statements, gift cards, and more. And if you love to travel, you can transfer those points. 1 mile equals 1 point. So to sign up for the Brex credit card, you are going to need an employer identification number, also known as an EIN, and your company must be registered in the United States. Okay, let's move on to the second credit card on our list. This card offers some of the best perks I've seen for a business credit card. We're talking no personal guarantee, a generous sign-up bonus, and travel credits that actually make sense. And as a welcome offer, if you spend $10,000 on eligible purchases within the first 3 months of opening your account, you receive $70,000 worth of points. But welcome offer aside, you earn 4 times membership reward points on eligible purchases for each dollar you spend in the top 2 categories of US gas stations, advertisements, restaurants, and supermarkets. And say you don't spend anything on those categories, fine. You still earn 1 times membership rewards points on everything else. And if your purchases are made primarily online, then this is absolutely the best credit card for you, because you earn an additional 1 times membership rewards points on shipping costs. And if you're lucky enough for your shipping points to wind up being the top 2 categories of the most spent, you'll enjoy 4 times membership rewards. In addition, you get 25% of the points you use to book a flight with your rewards using Amex Travel or other affiliated airlines. So in total, it's possible for you to get 250,000 rewards points annually. But here's the downside. The American Express Business Gold Card does have an annual fee of $295, which is relatively high compared to the other cards on the list. But you can weigh the cost of an annual fee with all of the perks and rewards that you get. Okay, let's move on to the next card on our list. Now, this is a card with no annual fee, something we all love, especially when starting a new business, making the American Blue Business Cash TM card one of the best cards for startups and small businesses. On top of having no annual fee, you also get 0% APR on purchases for the first 12 billing cycles, alongside a variable rate of 13 to 22%, which will depend on your credit worthiness. Now, we all love a good welcome offer. So what is it? With this card, you earn $250 in credit statements after eligible purchases of $3,000 within the first 3 months of your membership. In addition, you get 2% back on the first $50,000 you spend every single year. And after that, 1% on all other purchases, which beats no cash back each and every time. On top of all of this, your buying power is in your hands. What do I mean by this? Well, it means that you have the ability to go above and beyond your credit limit to keep your business afloat or to spend extra cash when needed. Your ability to do this will depend on your credit card usage, among other factors. You can also add an employee account to your American Blue business card and then earn rewards on all of their eligible purchases. Now, the only drawback I saw with this card is that it does have pretty high foreign transaction fees, which can be a turnoff for businesses that actually spend money overseas. Just something to look out for. Okay, next on our list, the Capital Spark Cash Select Card comes with a 0% APR for the first 12 months and a variable rate between 16% and 25% thereafter. This is another one of those cards that does not come with an annual fee, which is good for keeping those expenses low. But my favorite thing about this card is that you get 1.5% cash back on all purchases with no limits. In addition, the Capital Spark card has no foreign transaction fees, which if you buy your products internationally, that is a plus for you. You can also set and track employee spending limits and earn additional points when they spend money. And when it comes to paying off this card, the amount you pay will be the greater of $15 or 1% of your balance plus interest, late fees, and any other past due amounts. And another bonus is that you get to choose your monthly due date. But there's a drawback to everything, right? And the biggest drawback to this card is that it doesn't come with a welcome bonus compared to other cards on the list. Once again, you have to weigh the benefits of this card compared to any welcome offer. And heck, at 1.5% cash back on all purchases with no limits, this card is definitely the one for some people. All right, let's go to the next card. The US Bank Triple Cash Rewards Business Card has a fantastic welcome offer of 0% for the first 15 months. You heard that right, not 12, 15. After that, you get a variable APR between 14 and 24%. In addition, there is no annual fee for you or any of your employees. It also has a welcome offer of $500 when you spend $1,500 or more within the first 150 days of opening the account. Wait, but there's more. You get 3% cash back on all gas and EV charging costs, cell phone providers, restaurants, and office supply stores. And when you don't spend money in those categories, you get 1% cash back on all other qualified purchases. Get this, with no limits and no expiration. You also get 5% cash back on all hotels and rental cars booked using their travel reward center. In addition, you get $100 worth of software credit for recurring software subscriptions. Another way this credit card helps to lower your expenses. Now, this credit card does come with a personal guarantee, and you will need a credit score that is at least 670. And the main downside to this card is bank balance transfer fees and foreign transaction fees. Just something to keep in mind. Okay, next up. This card offers up to $100,000 in bonus points after you spend $15,000 within the first 3 months. That translates to $1,000 in travel rewards or $1,250 in cold hard cash. I'll take it. With the Chase Inc. Business Preferred Card, you earn 3 points per dollar on the first $150,000 in annual spend on categories like travel, shipping, internet, cable, and phone service. And 1 point for every dollar you spend on all other purchases, with no limit to the amount you can earn. And points are worth 25% more when you book through Chase's Ultimate Rewards, rather than going directly to an airline or a hotel. So if you want to maximize your points, make sure you do that. And to top it off, there are no foreign transaction fees for purchases made internationally. But here's something I want you to be aware of. The Inc. Business Preferred Credit Card does come with a $95 annual fee and a variable APR between 16% and 25%. Additionally, there is no introductory APR and no waivers of the annual fee even in your first year. So let's recap the best credit cards for startups and new businesses. If you're going to be traveling, the best business card for you is the Chase Inc. Business Preferred Credit Card. If you want no annual fee, the best business credit card for you is the American Blue Business Cash TM card. Now, if you're a startup, the best card for you is the Brex credit card. If you want cash back, the best credit card for you is the Capital One Spark Cash Select card. If you want a 0% intro APR, then the business credit card you want to get is the US Bank Triple Cash Rewards credit card. And if you make a ton of online purchases, then the best business credit card for you would be the American Express Business Gold Card. I'm going to reveal the best places to find grants to save you time and money. There are many places to look for grants, but they are often overly priced, overly confusing, or extremely outdated. So here are the top places to find a small business grant. Let's get started. Okay, first I want you to be clear on what a grant actually is. A grant is simply money that is awarded to businesses that the business does not have to pay back, which makes business grants very different than a business loan. Grants also differ from loans based on how they are awarded. You see, loans are often based on your ability to repay the loan back and use your credit and revenue to determine eligibility. But grants, on the other hand, are often awarded to those who can use the grant money most effectively. Now, there are two main types of grants. You have government grants that are provided by your federal and state governments, and you have private grants that are provided by corporations and foundations. Now that we understand grants, let's look at the top places to find a grant. The first place is your small business development centers. Yes, you can increase your chances of finding grants for your business by contacting your local small business development center. In addition to helping you find local and state grants for free, small business development centers help you get financing, develop your marketing, get counseling and training, and much, much more. And if that wasn't enough, your local small business development center can even assist you in applying for grants. Seriously, if you never reached out to your small business development center, do it ASAP. The next best place to look for grants is GrantWatch. Now, I like GrantWatch because it's an up-to-date database with over 26,000 grants for small businesses, nonprofits, and even individuals. Also, GrantWatch isn't just for federal grants. GrantWatch has corporate grants, foundation grants, local grants, state grants, and federal grants on their platform for you to choose from. And that's good, but there's more. They have a customer service line that will help you research and find the perfect grant for you. Now, the next place to look for grants is grants.gov. Grants.gov is a database managed by the federal government that lists all federal government grants across all their agencies, which makes it extremely easy to research and find federal grant opportunities for your business. Now, to be government ran, the database is extremely easy to navigate. You can filter based on keywords, status of the grant, funding type, eligibility type, grant category, and by government agency. Additionally, grants.gov provides an enormous learning center that can help you understand more about grants, including eligibility, the different program types, how to protect yourself from grant fraud, and more. If you need help applying for the grant or registering to the database, a video series is offered on the site that can walk you through step by step. Then there is score.org. SCORE is a nonprofit partner of the SBA or Small Business Administration, and they provide workshops, resources, tools, and mentors to aid in the success of small businesses. While SCORE does not directly provide grants, their small business mentors can help you with finding a grant and applying for grants. Heck, they even host webinars all about grants and the grant process. Last but not least on the list is to check with your local library. Yes, your local librarian has access to hundreds of databases, including those that have grants. And heck, they're very good at researching as well. Additionally, librarians can typically point you in the direction for resources and expert help that can assist you with finding, applying, and maintaining grants. Now, before you start applying for small business grants, make sure you already have the following items completed. First, make sure your business is incorporated. Sole proprietorships will have a hard time getting a grant. Secondly, make sure you have your business bookkeeping in order and taxes readily available. Though revenue will likely not be the biggest criteria for getting a grant, grantors will want to make sure your business has some history of being able to effectively sell your products, or your services. Lastly, have a plan for the money. Grantors will want to know why you need the grant, how you plan to allocate the grant money, and what type of impact the grant will have on your business and for your customers. These are all things that make up a good grant proposal, and I'd suggest spending quite an amount of time writing this out and refining your pitch before you apply for a grant. Now, let's look at 5 quick tips to help you when looking for and applying for grants. When researching, be sure to look for grants from companies and organizations that are aligned with your business values. Don't take money from simply anyone. Now, when researching, check eligibility requirements first. Only spend the time applying for grants you know you are eligible for. When researching, start with smaller local grants. They will likely have less competition, and you can improve your grant writing skills before going for the very big grants. Also, when applying, focus more on the solution or contribution you will be able to provide if awarding the grant money, and less on the business or problems in your business. And here's another thing. When applying, pay attention to the small details. Some grants have very specific requirements for things like word count, typeface, and more. And be sure to follow up. There's an old saying in sales that the fortune is in the follow-up. And that's true for small business grants as well. Once you submit your application, I would recommend doing 3 things. First, send a thank you note or email, and make sure you reach out to the organization thanking them for the opportunity. Then after about 2 weeks or so, send a follow-up email asking if your application has been reviewed. And then in another week or 2, try to call the grant office for a status update if you can. The goal with these tips is to remain top of mind for the grantors without crossing the line or being overly pushy. By doing so, you significantly increase your chance that your application is both seen and reviewed. You never know, it may even speed up the process for you. Now, here are a few more tips before you start applying for your small business grants. First, make sure your business is incorporated and an entity. Your business should have a unique employer federal identification number, also known as an EIN. This shows that your business is a real business. Second, your business and personal taxes should be complete. Grant providers will want to know the current standing of your business, including your income. So your tax return should be up to date for the most recent tax period. Next, your business book should also be up to date. In most cases, you must provide your financial records for your business in order to qualify for grants. They want to make sure you have a need for the money. Next, you want to be operating in a separate business bank account. Remember, grants are only free if you use the money appropriately. To make it easier for you to do your books and for them to audit if funds are used correctly, conduct your business transactions from a business bank account. And finally, have a plan for the money. If you are awarded grant money, what will you do with it? You should know this before you apply for the grant. Heck, you can even take this a step further by forecasting your financials based on receiving the grant money. Show them what you will be able to accomplish through the use of grant funds for yourself and for your customers. By tackling these items in advance, you will have a better chance of obtaining grant funds quickly. In short, make it easy for grant providers to give you the money you need to run a successful business. You will know every business loan type available to you as a small business. I'll be covering loan eligibility, needed documents, and how to compare loans so you get the best terms. Let's dive in. Okay, so there are many reasons why you may be interested in getting a loan for your business. To start the business, for working capital, for cash flow, for equipment, for emergencies, the list goes on and on. So let's start by understanding the types of lenders and loans available to you. The age of your business, the revenues of your business, and how fast you need the cash will influence which lender and type of loan will be the best for your business. There are 3 main types of lenders for a small business loan. First, there is the SBA. The Small Business Administration offers different types of loans for small businesses. And the biggest benefit of an SBA loan is that the SBA partners with lenders to provide loans and guarantees 75 to 90% of the loan for the lender. This results in better terms and easier qualifications for small businesses. Now, the downside of a business loan from the SBA comes in the form of increased paperwork and approval speeds that can be slower than other lenders, which makes an SBA loan best for any business that can weather the time it takes to get approved. Next, you have conventional banks. These are the regular everyday banks that provide loans to businesses. Think Bank of America or Chase Bank. Now, conventional bank loans generally have the best terms regarding interest rates and fees when it comes to small business loans. But the biggest downside of a business loan from a conventional bank is how difficult it is to qualify and get approved, especially for new businesses. So a loan from a conventional bank is best for established businesses with consistent revenues. All right, next we have alternative lenders. These will be your online lenders of capital for businesses. So what are the benefits of an alternative lender or online lender? Well, loan approvals typically take less than a few hours and funds are provided in less than a week. Alternative lenders also have the easiest eligibility requirements and less rules for the use of the funds. Which brings us to the downside of using alternative or online lenders. To make up for how quick you can get approved and funded, they typically offer the highest interest rates and fees compared to other types of lenders. But because it's so easy to get funding, alternative lenders are best for startups or business owners without high revenues. And popular alternative lenders include Cabbage, Funding Circle, Blue Vine, On Deck, or Fundbox. Okay, so we went over the lenders. Now let's talk about the types of loans you can get for your small business. First, bank loans. These are loans provided by conventional banks, and the benefit is that they typically have the best interest rates out of all loan options. But the downside is strict qualifications needed to qualify. You'll need great credit in an established business. So loans from conventional banks are best for established businesses with good credit. And these are going to be your popular lenders once again, like Bank of America, Chase, or Wells Fargo. Then we have SBA loans. And I first want to talk about the 7A loan, which is a loan program backed by the SBA for up to $5 million in terms up to 25 years. Now, the biggest benefit is that there are over 6 different loan programs to fit your needs. But the downside is that to qualify, you need at least a 690 credit score, 2 years in business, and consistent revenues. So once again, this loan is best for established businesses with good credit who don't need funds quickly. Next, we have microloans that are very accessible for businesses without large revenues or good credit. The downside is that the process can take a few weeks, a business plan is needed, and collateral against the loan is required as well as a personal guarantee. So this is best for startups or small businesses who have bad or no credit history. The next type of loan from the SBA is a 504 loan. And these are loans up to $5.5 million for the purchase of commercial real estate, land, and equipment with terms up to 25 years. Now, the biggest benefit of these loans is the relatively low interest rates and small down payment of only 10%. But here's the downside. It's a lengthy process with involvement from both a bank and an SBA approved certified development company, also known as a CDC. So this is best for established businesses who need to purchase equipment or buy real estate. Now, the next type of loan you can get is called a term loan, which is a lump sum paid back in fixed increments over time. The biggest benefit is that it's fast, has online approval, and fund disbursement with a consistent payment schedule. The downside is that interest rates and fees are typically higher than conventional bank loans or an SBA loan. So this type of loan is best for startups or business owners with not so great credit. And popular lenders include Cabbage, Funding Circle, Blue Vine, On Deck, and Fundbox. Then there's the line of credit, which is a fixed and flexible revolving access to cash up to your limit. The benefit is that interest is paid only on the amount drawn. And once you pay it back, the funds are immediately available for use again. The downside is that fees can be costly and borrowing amounts can be lower than with a loan. So this is best for all businesses who can qualify, and popular lenders of a credit line includes Cabbage, Blue Vine, and Foundation. Our next type of loan is called invoice financing, which is a cash advance, typically 50 to 90% on unpaid invoices. It's actually not a loan, but the biggest benefit is that it's easier to qualify for than other loan options due to the invoices being collateral. The downside is that fees can be greater than other loan options and funds are dependent on your sales continuing. So this is best for businesses with consistent sales, and popular lenders include Blue Vine and Fundbox. Then there's the merchant cash advance, which is a cash advance on unpaid credit card sales. The benefit: bad credit or minimal business history can still qualify. The downside is that this is the most expensive form of financing available. So it's best for businesses who have exhausted all other loan options. And popular lenders include Rapid Finance, Can Capital, and even PayPal. Then there's equipment financing, which is loans specifically for purchasing equipment. The benefit: low interest rates, fixed monthly payments, and leases may be available for the equipment. The downside is that funds are limited to only purchasing equipment. So this is best for businesses who need equipment and don't want to purchase up front. Popular lenders include Crest Capital, Balboa Capital, and Currency Finance. Now, let's talk about secured versus unsecured business loans. No matter what lender or type of loan you decide to go with, the loan will either be a secured loan or an unsecured loan. Secured loans use assets as collateral or recourse in case you default on the loan. Collateral provides some form of protection for the lender and generally results in better loan terms. And common types of collateral include real estate, equipment, cash, cars, outstanding invoices and payments, and even future revenue. The amount of collateral needed will vary depending on the lender, the type of loan, and the loan amount. Unsecured loans do not require collateral and are therefore more risky for the lender. The higher risk typically results in stricter requirements and or higher interest rates. Now, you can't just walk into a bank and get a loan. You'll need a few documents first. And no matter what type of loan you apply for or what type of lender you go with, here are the documents that you may need to provide. Tax returns. This is going to be personal income tax returns along with business returns if applicable. This may also include K-1 statements for partnerships or an S-corporation shareholders. Next up, you have income statements and balance sheets, which are financial documents that provide a snapshot into the business performance, assets, and liabilities. Then you're going to need business and personal bank statements. You're going to need business legal documents also, which are business certificate, licenses, and contracts if they apply. And lastly, a business plan. All right, let's talk about loan eligibility. Each lender and loan type will have their own specific requirements, but most take into account the 4 C's. The first C is capital, your ability to repay by looking at your business and or personal earnings, savings, and debt. Then there's credit, which is the credit history of your business and or you personally. Next, we have collateral, which are assets that can be used to secure the loan if it is a secure loan. And lastly, conditions, which is the purpose of the loan, time in business, and industry of the business. Okay, so you understand the types of loans and what you need to get a loan. Now let's talk about how to compare lenders. Okay, assuming you qualify, when comparing 2 or more loan options against one another, look at the following items to determine if it is the best option for you before signing the dotted line. So first, look at the interest rate and APR. Interest rate is the annual cost of the loan as a percentage. APR is the annual cost of the loan plus any fees. Next, ask yourself, is the interest rate fixed or variable? Look for additional fees like application fees, origination fees, servicing or process fees, non-sufficient fund fees, closing costs, prepayment fees, late payment fees. Administrative fees. Just look for the fees, both hidden and not hidden. Next, take into consideration the fund amount. What is the max amount allowed to borrow? Next, look at the repayment terms. How long will you have to repay the loan? How often do you have to make payments? Is there a balloon payment? How much is the monthly payment? What collateral is needed? Is the loan secured or unsecured? And if it's unsecured, what collateral is needed? Okay, let's look at a loan comparison example. Notice how loan B has lower monthly payments and a longer term, though it results in a larger amount of interest paid over time. So don't be fooled. Once again, look at the loan amount, the APR, loan terms, monthly payments, interest paid, and also fees. Okay, so we already know that SBA loans tend to offer low interest rates, long repayment terms, and various loan programs. But here's something else I want you to know. The SBA themselves do not provide loans. The SBA partners with lenders to provide the loans and then guarantees 75 to 90% of the loan for the lender. And this guarantee by the SBA results in better terms and easier qualifications for small businesses. Currently, the SBA offers three main types of funding programs. The first and most popular funding program is the 7A loan. This program provides a variety of different loan types with funding up to $5 million in terms up to 25 years. The second funding program offered by the SBA is a microloan. Now, microloans are loans up to $50,000 for startups and small businesses with terms up to 6 years. The last funding program you'll find at the SBA is a 504 loan. Now, 504 loans are very specific and offer loans up to $5.5 million for the purchase of commercial real estate, land, and equipment in terms up to 25 years. Each SBA loan type will have slightly different requirements, but there are a few general requirements that must be met to be approved for an SBA loan. First, for-profit business. To be eligible for an SBA loan, you must be a for-profit business, must be owned and operated in the United States, and must have a mailing address in the United States. Additionally, you must also be legally organized as a sole proprietorship, corporation, partnership, or LLC. Unfortunately, most nonprofit organizations are not eligible for an SBA loan. Next, you must be in an eligible industry. Yeah, not all businesses are eligible to receive a loan from the SBA because of the industry they're in. These include businesses that primarily engage in lending activities, gambling, lobbying, or politics, or businesses that provide life insurance, or have what is deemed a speculative business such as medical research. Also, businesses that are passive in income, deal with pyramid sales, distributions, or compensations, primarily offer religious services, sell adult entertainment services, or package SBA loans. You also must be an eligible owner. Certain owners of a business void the ability for the business to get an SBA loan. Now, an owner is someone with 20% or more ownership of the company, and a business is not eligible for an SBA loan if our owner of the company is incarcerated, on probation, subject to formal criminal charges, or is delinquent or has defaulted in the past on a federal loan or financing program. Having a criminal record does not automatically disqualify you unless the crime is considered a felony of moral turpitude, which means it involved violence or dishonesty. Next, you're going to need investment. Another requirement for an SBA loan is that you have invested in the success of the business. This can be via time or via money to get the business started and continue the operations of the business. Then there's business size. Your business must be considered a small business as defined by the SBA. What is considered a small business will differ depending on your industry. For example, depending on your industry, what can be considered a small business can range from under 100 employees to under 500 employees. In addition to employees, your revenue and business net worth will help determine if you are classified as a small business. Say you're unsure if you qualify as a small business, the SBA actually has an interactive tool that you can use. Then you're going to need limited options for funding. SBA loans were created to help those who may have trouble getting a loan elsewhere actually get a loan. Most people don't know this, but to be eligible for an SBA loan, you actually have to be ineligible for financing options elsewhere. You won't have to provide proof of this, but your SBA lender will generally document this. The next general requirement is time in business. Outside of SBA cap lines, which require you to be in business for at least a year, the SBA doesn't have a set amount of time you need to be in business to be approved. With that being said, different lenders may have their own requirements. And generally, the longer you've been in business, the easier it will be for you to get approved for an SBA loan. Those who just started their business and have no experience in that industry will be seen as risky by lenders. And many lenders will require you to be in business for at least 2 years at a minimum. But there are lenders who do offer SBA loans to startups. If you have been in business less than a year, the ability to demonstrate revenue growth over time will be extremely important. Another requirement is personal credit. Your personal credit score is a factor when it comes to being approved for an SBA loan. Similar to your time in business, the SBA does not require a minimum credit score, but specific lenders do. At a minimum, lenders will typically want you to have a 640 score or higher, but a 700 or higher will give you the best chances of approval. Speaking of credit, business credit is also a factor when it comes to being approved for an SBA loan. The SBA lenders will use the FICO Small Business Scoring Service, also known as the SBSS. Your business score will range from 0 to 300, and the SBA uses your SBSS score to pre-screen those who apply for 7A loans. Now, the SBA will want to see a minimum business FICO score of at least 155, but lenders may set their own minimum score for approval. If your business FICO score isn't high enough, having a higher personal credit score will help your approval chances. You're also going to need collateral. The SBA requires lenders to obtain collateral to secure the loan from all owners of the business, aka anyone who owns 20% or more of the business. Now, collateral will typically be in the form of a personal guarantee and other qualified collateral. Qualified collateral can be office equipment, machinery, buildings, accounts receivable, inventory, or a second mortgage on a home. Note that collateral isn't required for loans under $25,000. For loans over $350,000, collateral must cover as much of the loan as possible. Now, the last general requirement to get an SBA loan for your small business is personal and business documents. The exact documents you will need to provide will differ depending on the loan program, but here are the documents you can expect: a business plan, personal financial statements, business financial statements, business certifications or licenses, personal and business tax returns, your business debt schedule, bank statements, and incorporation documents. As mentioned, each SBA loan program will have its own specific requirements, but those are the general requirements. So, is it worth it to apply for an SBA loan? Well, the biggest benefit of an SBA loan is that SBA partners with lenders to provide the loans and guarantees 75 to 95% of the loan for the lender. This results in better terms and easier qualifications for small businesses, especially startups. Now, the biggest downside is that the SBA loan comes with increased amount of paperwork, and approval speed can be much slower than other lenders. If you can weather the time for approval, an SBA loan may be a great option for your business. Today, I've put together the ultimate list of small business loans that can help your business move towards its goals faster. Now, there are many reasons why you may be interested in getting a loan for your business: to get your startup off the ground, for working capital or inventory, to provide a cushion for cash flow, for new marketing initiatives, for an emergency. The list is literally endless, and therefore I provided the best loan there is for each of these scenarios and more. Whatever your needs are, you'll find the loan that fits. So let's get right into it. The best overall loan will come from Lendio. Lendio has options for loans ranging from $1,000 to over $1 million. And all you have to do is provide Lendio with a few specifics of your business, like your time in business, your revenue, and your credit information. Once you do, Lendio will provide you with the terms of the loans that are available to you based on this information. Lendio works with over 75 lenders to get you the loan that you need, matching you with the loan best for your situation. Even if you're just starting out or have been established for years, Lendio has options for you. The best lender for business startup loans is Axion. Through its partnership and outreach, Axion targets underserviced entrepreneurs, including entrepreneurs of color, low income, and women who often lack access to the financial services needed to build and grow their businesses. Axion is a nonprofit lender providing loan amounts from $5,000 to $10,000 with transparent terms and no repayment penalty. Axion has interest rates as low as 5.99%, and these rates can vary based on the chosen repayment plan. Axion also offers educational resources, coaching, and access to support networks for new entrepreneurs to help ensure your success. And the best part is that Axion's loans are very easy to qualify for. You just need to have the following: a credit score of 525 or higher, or no credit score at all. Have cash flow to pay for the loan. Have paid your rent or mortgage on time for the last year. Not be currently more than 30 days late on any bills. And not declared bankruptcy in the past 12 months or had a foreclosure in the past 24 months. And you can probably obtain a loan. And even those last two requirements are flexible for loans under $2,500. Okay, the best lender for low credit is Fundbox. If you have low credit, you can usually get slightly better terms with Fundbox. Fundbox provides loans from $1,000 to $150,000, and unlike many other lenders, there are no specific requirements for 6 and 12 months lines of credit, and they provide repayment terms of 12 or 24 months. Fundbox does require a minimum credit score of $600 to qualify. It also requires at least $100,000 of annual revenue, and you must connect your accounting software or bank account. Now, as far as Fundbox's costs go, the APR on Fundbox's line of credits range from 10% to 80%. The best lender for personal loans is Fundera. Fundera is the loan service with the financial site NerdWallet backing it. They can provide all sorts of loans up to $1 million, but with rates as low as 6%. But here's the kicker: Fundera's personal loans is what separates them from the pack. Because if you run a business, it's very important to keep personal and business financial matters separate. So people often use personal loans for things like student loans, home improvement, medical bills, car payments. You get it. But the key here is that Fundera offers personal loans for business with max loan amounts up to $50,000, loan terms of 3 to 5 years, interest rates of 5.99 to 35%. And you can get loans as soon as 1 day, but I do want you to remember this. With a personal loan, your personal assets are the collateral, and this loan will go on your credit report. Okay, the best loan for P2P lending is Funding Circle. Funding Circle connects you with P2P lending sources. Those are sources who are accredited and institutional investors. So to find the funding needed, rather than going to a bank for funding, Funding Circle underwrites and manages their own loans. You can apply for a Funding Circle loan online in as little as 6 minutes and get a decision in as little as 1 business day after submitting documents, which makes Funding Circle a good option for businesses that have the following. You've been in business for at least 2 years. You have a personal credit score of 660 or higher. You've had no bankruptcies within the last 7 years. And your business is not located in Nevada, simply because Nevada has a unique state commercial lending regulation. Now, the most convenient place to get a loan is through Kabbage. Kabbage is a small business lending arm of American Express and offers lines of credit ranging from $1,000 to $150,000. But what makes Kabbage great is that each draw on the line of credit is a separate 6, 12, or 18-month installment depending on your eligibility. And you can have more than one loan at a time as long as it does not exceed your maximum loan amount. So say you're approved for a $75,000 line of credit, but choose to draw several loans of $10,000 each when your business needs some funds. Each one of those $10,000 loans will have a separate loan agreement. You only pay for fees on the loan amount, not for the full line of credit. Okay, the best lender for microloans is Kiva. Kiva is another nonprofit that provides access to capital for entrepreneurs across the globe. And more than 2.5 million people have raised over $1 billion on Kiva. You can obtain up to $15,000 at 0% interest. Yes, really, 0%. And there's no catch. Kiva is a nonprofit aimed at expanding access to capital. Any business can apply, but not all are pre-qualified. It does take time to get funding, but once you do, you have 3 years to repay the loan. Kiva may be exactly what you need to get your business and your dreams moving forward. If you're going to be doing repeat borrowing, you're going to want to go with the lender On Deck. On Deck has a similar line of credit as Kabbage, which is used for managing your business's cash flow, such as buying inventory or making payroll with access to cash when needed. It offers loan amounts from $6,000 up to $1,000 and has a 12-month repayment term, which resets after each withdrawal. It has a minimum requirement of 1 year in business, a 600 personal FICO score, a $100,000 business annual revenue, and you must have a business bank account. The best lender for SBA loans is SmartBiz. So if you're looking for an SBA loan, SmartBiz is for you. The good news is that you can see if you pre-qualify for up to $350,000 in as little as 5 minutes without impacting your credit score. SmartBiz works with multiple banks so that you don't have to go searching, and matches you with a lender most likely aligned with the use of SBA loan proceeds. And you can use these proceeds for things like working capital, debt refinancing, commercial real estate, new equipment, hiring employees, marketing, business expansion, and a whole lot more. The SBA loans from SmartBiz can range from $30,000 to $5 million and have interest rates from 4.75% to 7%. They also give you repayment terms from 10 to 25 years. If you have large cash flows, you want to get a loan from Bluevine. Bluevine has a simple system to see if you are right for their loans. Bluevine search is free to use with no hidden fees, and they provide loan amounts from $5,000 all the way up to $3 million. And their funds can be available as fast as the same day. So what are the requirements? Well, if you're looking for a Bluevine line of credit, you must have been in business for 6 or more months. You must be able to show $10,000 in monthly revenue, and you must have a credit score of 600 or more. All right, once you've done that, I want you to register with your state and obtain a sales permit if necessary. In most states, you will need to register to pay state-specific business taxes, including income taxes, employment taxes, and sales taxes. This is typically done online via your state-specific tax portal. Also, you may need to obtain a seller's permit if you have an online business or have a service that needs to collect sales tax as well. Now, the last thing I want you to do, and this is a big one, so lean in for me. I want you to budget for taxes. So let's start off by determining what a tax write-off even is. It's pretty simple. It's just an expense that you can use to deduct from your taxable income come tax time. So here's an example. You have $100,000 in revenue, but you found $20,000 worth of write-offs that you can deduct from your taxable income. So that $100,000 in revenue drops down to $80,000 in taxable income because you found write-offs worth $20,000. So now that that's clear, let's talk about the big 12, right? The 12 biggest tax write-offs that you can use as a small business. So the first thing that you can write off as a small business owner is your travel. All the expenses related to business travel can be written off. This includes the cost of your ticket, your hotel, your Uber, your rental car, your dry cleaning, your tips, and more. And in the instance that you like to mix business and pleasure, and that business trip turns into a vacation, you can write off the portion of the trip that was used for business, not the entire thing. But to be able to write your business off as travel, you must meet the following 3 conditions. First, the trip must be necessary and ordinary for your business. Secondly, the trip must be in a different city than your business address. And lastly, you must be traveling for more than a business day, and the trip must require lodging. So I made a complete video on business travel and how to write it off. So if that's interesting to you, make sure you watch it after this video. I'll link it in the description. All right, business write-off number 2 for your small business is your home. Because if you use a part of your home exclusively and regularly for your business, then you can write it off. And you do this by using the home office deduction. But listen closely, because there are two ways that you can go about writing this off. First, you have the simplified option, which lets you write off $5 per square foot of your home. Now, that's up to a limit of 300 square feet. And like the name implies, this method is simple compared to the second method. And the second method is called the regular method. Now, this method, as I mentioned, is a bit more complex, as it requires you to calculate all the expenses that you use for that home office as a percentage of your total home expenses. So, Karan, what does that really mean? Well, common home expenses that you can write off using the regular method includes the following: utilities like electricity and internet, mortgage insurance and interest, homeowners association, renters insurance, and even depreciation. All right, write-off number 3, your kids. So employing your kids can lead to a ton of tax savings. If your child is under 18, then their income isn't subject to Social Security or Medicare tax. And if they earn less than the standard deduction, then they won't owe any taxes either. And that's the win-win, because they don't pay any taxes and you get to write off the salary that you give them. But there's the key here, right, that you can't miss. The work that you give your kids to do must be legitimate, age appropriate, and at a fair rate. All right, number 4 on the list is your education. So education expenses related to your business can be deducted. Courses, books, webinars, workshops, you name it. If it's education for your business, you can write it off. And then we have number 5, which is your meals. So whether it's a quick coffee with a client or a dinner to close a deal, your business meals are tax deductible. So the next question is, how much can you deduct? 10%, 20%, 100%? Let's talk about it. And let's talk about my favorite, which is 100% first. So if you want to write off 100% of your business meals, then they have to fall under these categories. It can be a meal for recreational employee events, like holiday parties, team building activities, summer picnics for the team, right? Or the meal has to be essential for your business. So if you're a food blogger, your business depends on meals. So you can write that off 100%. And the last category of meals that you can write off 100% of the way is meals that are provided or sold to customers. All right, so that's the 100% category. Let's talk about the 50% category. Meals during a business trip, right? We talked about business travel earlier. If you're on that trip and you decide to eat, which I'm sure you will, then you can write off 50% of that meal. And the last category for 50% business meals is in-office meals for employees or customers. All right, number 6 is your startup costs. Now, this is the big one for new business owners. The IRS allows you to write off $5,000 in startup costs and another $5,000 in what's called organizational costs. So, Karan, what's the difference? Well, startup costs are the costs incurred to actually start the business, right? So that would be costs to research the business, get an office, business cards, training yourself or your staff, and everything in between, right? Startup costs. Now compare that to your organizational costs. Organizational costs are the costs to incorporate your business. So think costs to incorporate your LLC, right? Legal fees and state incorporation fees. Now that's pretty simple, but it's not that black and white. There's something that you need to be aware of. If your startup costs are over $50,000, then your allowable deduction is reduced dollar for dollar above $50,000. And if you spend more than $55,000, the deduction disappears completely. The 7th thing that you can write off as a small business is your healthcare. Now, this is one of those deductions that are highly underrated and highly underutilized, but is massive if used correctly. And that's because if you have what's called a high deductible health plan, then by using an HSA, also known as a health savings account, you get what I call the triple tax break. Here's why it's called the triple tax break. Contributions are tax deductible. Growth is tax free. And withdrawals for eligible healthcare, that's also tax free. And here's a quick tip. you can use the money in an HSA to invest in the stock market and have that money grow tax-free. Now, for 2023, the contribution limit is $3,850 for self-coverage and $7,750 for family coverage. So all in all, it's a tax benefit and a health benefit in one. All right, write-off number 8 is your vehicle. So there are 2 ways the IRS allows you to write off your vehicle as a small business. And the first way is called the standard mileage rate. And when you use the standard mileage rate, you multiply the miles driven for business by the standard mileage rate set by the IRS. So for 2023, the standard mileage rate is 65.5 cents per mile, which is actually up 3 cents from last year. So if you drove 1,000 miles for business, you would multiply that 1,000 by 65.5 cents. Now, the second method is called the actual expense method. And when you use the actual expense method, you track all of your expenses. So the gas, insurance, repairs, you get it. You multiply those expenses by the percentage of miles driven for business. So if you have $5,000 in vehicle expenses and you use your car 20% of the time for business, you would multiply 5,000 by 20% to get a total deduction of $1,000. But regardless of the method that you use, be sure to keep detailed records of the miles driven specifically for a business. And if you want to see a video that goes into deep detail about writing off your vehicle, then watch this video next. All right, write-off number 9 is your furniture and your equipment. If you're running a business from home or have a designated office like we talked about, then you can write off the furniture and the equipment for that space. So take this office, for example. Right over there, I have a desk, right? I have floating shelves. I have books that I read for business, right? I have a chair right here, monitors, right? All of these things can be written off. So you're gonna wanna keep track of the things that you spend for your office because the IRS allows you to write these things off. Now, the 10th write-off is your cost of goods. If you sell a physical product, you can write off the entire cost associated with creating that product. So common costs of goods include raw materials, packaging, supply costs, equipment costs, shipping costs, storage costs, commission and affiliate costs, overhead costs, right? I think you get it. All of these things can be written off under cost of goods. So be sure to include and document and track all the expenses that you incur to create your products. All right, number 11, work clothes. So you may be able to write off clothing that is ordinary and necessary for your business to operate. Now, writing off clothing can be tricky, but here's a rule of thumb that I want you to follow. And that's if the uniform, right, or the clothing that you wear for your business can be worn outside of work, right, or outside of your business, then it's not deductible. You can't write it off. That means that you can't write off a suit even if you wear it specifically for your business and only for your business, because a suit is generally accepted outside of work. But here are a few examples of clothing that are considered deductible. Protective clothing, right? Like boots and masks, or uniforms, which are company logo on it, and even costumes. And then we have number 12, which is all ordinary and necessary expenses. Look, the tax law allows you to deduct any expenses that is ordinary and necessary for your business. Ordinary simply means that it is commonly accepted in your industry. Necessary means that it is helpful and appropriate for your business. But whatever it is that you plan on writing off, be sure to keep clear, detailed records of those expenses. Last thing I want you to do, and this is a big one, so lean in for me. I want you to budget for taxes. Yes, where there's revenue, there are taxes to be paid. I can't tell you how many business owners I've worked with who were shocked at the end of the year when it was time to pay federal and state income taxes. They completely forgot to budget for them. I suggest building taxes into your business's budget. Wait, even better, account for them in the margins of your products or services, so taxes are always accounted for. At the very least, be aware that they exist and the respective deadlines so you avoid paying late penalties. Depending on your business and the state you do business in, the taxes you are responsible for will differ, but here are the 6 most common. You have income taxes, self-employment taxes, estimated taxes, payroll taxes, excess tax, and sales tax. Keep these in mind as you grow your business. LLCs get taxed like simpler businesses by default, right? So a single member LLC gets taxed like a sole proprietorship. A multi-member LLC gets taxed like a partnership. Both slow profits due to the owner's tax returns, but those are the differences, right? Single member, sole proprietorship, multi-member, partnership. That's the default classification for the IRS when it comes to taxes. So let's go over it in a little bit more detail. For multi-member LLC, once again, it's treated as a partnership. So you file your 1065, the IRS does not tax the LLC directly, and each owner receives a K-1, right? That shows the profit and loss for that particular member. So how do multi-member taxes work? Well, each member pays on their share, distributed or not, right? So that's both self-employment tax and income tax, right? Profit is taxed whether you withdraw or not, and there's no avoiding the tax by leaving it in the business, not with a LLC as a default. All right, so let's talk about pass-through taxation. Well, pass-through taxation is simply the fact that the profit and loss passes through directly to the personal tax return, right? Profits appear on owner's personal return, and it avoids the double taxation corporations face. Even though corporations can keep money in, and well, okay, I won't even get into that yet. We'll talk about that. So let's talk about the core taxes that LLC owners face. Well, LLCs are only taxed on their net profit, right? That being income minus deductible expenses is your taxable profit. Once again, its profit is taxed whether you withdraw it or not. I have to make that clear. And owners, not the LLC, write the check to the IRS. The owners do. So what taxes actually apply to the owners? Well, they face three main taxes. The first one is self-employment tax. That's Social Security and Medicare. The second one is federal income tax based on their tax bracket. And the third one is state income tax in many states. Some states don't have state income tax, but most do. So let's go a little bit more into detail on self-employment tax, because you pay both halves of self-employment tax, that being Social Security and Medicare. And that tax is a flat rate at 15.3% of net profit, not your gross profit, 15.3% of net profit. So that covers the employer share and the employee share, right? Because you're basically acting as both. And every self-employed owner owes it, unless you do what we're going to talk about a little bit later in this video. But let's go over an example with real numbers. So let's use 100K profit. And on 100K profit, your self-employment tax alone is $15,300, right? Because 100,000 times 15.3% is $15,300. But that's not all your tax, because you still owe income tax on the full 100K. All right, so you can see how that burden adds up. You have this plus this to pay in taxes. So let's look at the true total tax load. Well, LLC owners often lose 25 to 40% of profit simply to taxes. Man. And self-employment tax plus income tax together equals the real cost. And most LLC owners forget that, especially self-employment tax. They completely forget that a lot of times. Right? So many owners underestimate that, and planning for it is the only way to reduce it. So LLC owners pay as they go, not once a year. So LLC owners pay as they go, not once a year. So what does that mean exactly? Well, the IRS requires quarterly estimated payments. No automatic paycheck withholding, like W-2 employees get. Of course, it's not that easy. So you must plan for your own cash flow. But what are those quarterly deadlines? Well, there's four that you need to keep in mind. We have April 15th, we have June 15th, we have September 15th, and we have January 15th, right? So we cover the year's taxes in installments, 4 installments, right? And missed deadlines trigger penalties. So who is required to pay these quarterly taxes? Well, Most LLC owners must pay quarterly taxes, all right? Especially, here's a little trick, all right? This is going to be a little off topic, but here's a little trick. The people who don't have to pay this quarterly are the people who reduce their taxes to zero for the previous year, right? So your quarterly taxes are based on what you made last year, what shows up on your return. So you don't want quarterly taxes the year following? Well, you have to reduce your taxes to zero, or at least as much as possible. And that'll reduce your quarterly taxes moving forward. That's just a little tip there. But let's get back to it. So once again, most LLC owners must pay quarterly taxes. And the rule there is that if you owe more than $1,000 in taxes, well, then you got to pay. Almost every profitable owner qualifies, as I mentioned, and paying avoids a painful year-end bill. Once again, you have penalties and interest. So how do you calculate those payments? Well, you estimate your profit, apply a tax rate, and divide by 4. So you estimate annual income and deductions, you apply self-employment tax and income tax, and then you divide that total by 4 quarterly payments. But we can't forget about state taxes, all right? And there are 2 ways that states tax LLCs. Some charge a flat annual fee, which is called a franchise tax. Others add income tax on the profit. But the rules vary widely from state to state to state. Some states don't charge at all, right? Now, how to pay the IRS? Well, you pay them online or by mail. And the most important thing is that you just keep records. For most people, their tax preparer or CPA will do this for them. But if they don't, then this is how you do it. So we have the IRS direct pay, which is the fastest and what most people use. Or you have the mail-in form with a check. But you always want to save your proof of payment. That's going to be important there. So what happens if you miss a payment? Well, we know it can't be good, right? So let's look at it. The IRS charges extra if you're late or you're short. So if you're late, you have 0.5% per month up to 25%. That makes me scared just thinking about it. I don't even like it. And if you underpay, you have additional penalties. But exceptions do exist for hardships or uneven income, right? So if something happens in your life that's considered a hardship and you just don't have the money where you can go on a payment plan, and the IRS will work with you in most cases to pay that tax burden off within the next year or a couple of years. All right, so let's look at the big picture of the LLC tax options. Well, there are 3 tax lenses, right, that I want you to look through when you're thinking about LLC taxes. The first lens is the default lens, right? We talked about that. That's pass through, and that's whether you're going to be looked at as a sole proprietor or partnership in the eyes of the IRS. The next lens is to elect S-corp taxation. And the third lens is to elect C-corp taxation. So let's talk about each one. When, why, how. Okay. So an LLC can be asked to be taxed like an S-corp, right? You just file Form 2553 with the IRS to do so. This allows you to have a salary plus distribution split, right? And that split helps you to cut off your self-employment tax burden, right? So let's talk about exactly how that's done. So when it comes to S-corps, only your salary gets hit with self-employment tax. So your wages are the ones that are subject to self-employment tax. Your distributions are not subject to self-employment tax. So overall, your tax burden can drop significantly. So let's look at some numbers behind it. Well, let's say you have $100K profit as an S-corp, right? Your salary, you make $60K, and generally that is based on your title, what you do, and the market rate for what you do. That's how you should determine your salary. But in this case, let's say $60,000, right? That $60,000 will be taxed with the self-employment tax of 15.3%, giving you a tax of $9,180. Your distributions, however, that $40K left over, that's not salary, has no self-employment tax, which means that you have a tax savings of nearly $6,000. What? Yep. So that's why people love S-corps. All right. So when does it make sense to become an S-corp? Because it doesn't make sense for every LLC. In fact, most LLCs, it likely doesn't make sense for, and I'm going to tell you why. So S-corps work best once profits pass 50K. Why is that, Karan? Well, that's the case because under 50K, the savings you get from moving to an S-corp does not surpass the administrative costs and the administrative burden, right? So it works if you're willing to run payroll, right? It works if you're willing to go through the extra filings. It's a smart step for growing businesses, but you have to be at that 50K number. Anytime before it, it's gonna waste your time, and you're just gonna have way more paperwork, way more things to keep track of. Just trust me. But that's not the only option, right? You also have the C-corp option, which a lot of people don't talk about. So let's talk about it. An LLC can elect to be taxed as a C-corp. They file Form A832 with the IRS, and when you are taxed as a C-corp, well, those profits are taxed at a flat 21%. That's the corporate rate. Your dividends are taxed again. That's double taxation that comes with being a C-corp. So that doesn't really sound appealing to a lot of people. But let's see when C-corps may help you. Well, C-corps fits high growth or reinvestment heavy companies. They're best if profits are reinvested, not withdrawn, right? So it's good for that. You get great access to health insurance and retirement perks by being a C-corp. And it's just a great long-term strategy for scaling your business. Once again, best for high growth companies or companies that reinvest heavily. They want to be C-corp. So what are some ways to reduce taxes? I'm just going to tell you right now, this is my favorite part. Maybe you like paying taxes. I don't know, but I don't. Okay. So I love this part on how to reduce the taxes. So let's talk about it. So there's two ways to lower your taxes. So here's the framework. Here's the lens that I want you to look at this through. You reduce your taxes by either lowering your profit or shifting it, right? So you reduce your profit with business deductions, all right? You shift, well, deductions, let me say, and credits, all right? You can't read that, but it says credits. Or you shift profit with strategies like tax selection, like we talked about, family hires, retirement, so on and so forth. And both of those options keep money in your pocket legally. So let's look at some common deductible expenses, right? And let's throw some credits in there too. So any ordinary and necessary expense can shrink your taxable income. So deductions like the home office deduction, right? The mileage deduction, you buying supplies, you having subscriptions, online subscriptions for the things you need to run your business. Those deductions help shrink that taxable income. Now, credits, on the other hand, like the work opportunity tax credit and the R&D tax credit and so many other tax credits, also help you do the same thing, but there's a difference between a deduction and a credit because every dollar deducted lowers your profit, your taxable income. But every dollar credited lowers your actual tax liability. So credits are actually worth, in some cases, a lot more than deductions, but you want both. If you and try to find both, as many deductions, as many credits as you can to lower that taxable income and to lower your tax burden. So let's talk about using retirement to save on taxes. Not only does it save on taxes, it allows you to build wealth. So things like your solo 401k or your SEP IRA for owners, right? Because those contributions reduce taxable income now. and they grow tax-free, or they grow tax deferred, not tax-free, for future use. All right, we have some other creative strategies though. There are many other deductions, many other credits, and strategies that you can use to lower your taxes. So what I want you to do is go to keepmost.com. That's KEEPMOST.com. It's a platform with every credit, every deduction, every strategy specific to your business, income, situation, personal details. The same details that your CPA would give you, same strategies, right, are here. And it's not live yet, but it's releasing soon. So you can join the waitlist and get a discount for it right now if you're serious about lowering your taxes. All right, so let's look at some common mistakes to avoid. Mistake number one, as we talked about, is ignoring self-employment tax. Simply forgetting that there is a self-employment tax creates a nasty, nasty, nasty surprise. Many new owners underestimate it or simply forget it, which leads to IRS bills they can't pay. So many stories of this. So always plan for it up front. That's what I want you to do. Plan for that self-employment tax. And better yet, plan for deductions, credits, and strategies that allow you to not have to pay taxes at all. But anyway, let's go over mistake number two, which is not paying your quarterly payments. Right? So when you skip those quarterly payments, it costs you twice. It costs you with penalties, and it costs you with interest added to that tax bill. All right? So, which leads to a big year-end crunch for owners. So you want to use your calendar reminders to stay compliant there. And all these and deadlines like quarterly payments are also within KeepMost as well. So that's just a plus there. All right. Let's look at mistake number three. It's mixing business and personal assets. So mixing money destroys both tax clarity and liability protection. Why? Because the IRS and courts treat it as piercing the veil, right? They're not separate anymore. You and your business are not separate if your assets and the money and your transactions all commingle with one another. So it creates bookkeeping chaos and lost deductions, as well as lowering your liability protection. So you always want to use separate accounts for your business and your personal life. All right, mistake number four is poor record keeping, right? So bad records equal lost money and higher audit risk. So lost receipts means lost deductions. Inaccurate books trigger IRS red flags. So you're going to want to use bookkeeping software or hire help. Okay. Mistake number five is forgetting required IRS forms. So missing filings can undo all your tax planning. So here are the things you must file. Multi-member LLCs must file a Form 1065 plus a K1. S-corps need to file Form 2553 plus payroll reports. Late forms equals penalties and loss of tax status in some cases. And the next thing that I want you to do is that if you need help with LLC tax strategy, like I mentioned before, I've been working on something extremely special for our YouTube family. It's a tax credit and tax write-off platform called KeepMost. And once again, we baked in all of the tax strategies, the deductions, the credits, the income shifting strategies, the entity strategies, so on and so forth, right? The same things that your CPA or the best CPAs will provide for you. We baked it into a platform for less than $2 a day. When to pay yourself, how much to pay yourself, and a very simple process to setting this all up and making it easy for you. let's dive in. One thing I need you to understand, right, is that it's a 5-step process, 5 simple steps to paying yourself properly. The first step is asking yourself, can the business actually afford to pay you? The second step is asking yourself what your payment options are. Next, how much is actually safe to pull out of that business? 4, how do you even set it up to pay yourself? And last but not least, what mistakes you need to avoid. We're going to be covering all of this step by step right now. Step number 1 is, can you actually pay yourself? Here's the thing. Your business eats first and you eat second. You flip that around and you don't have a business any longer, okay? Right? You want to cover your business bills first. So one thing you need to do to start this off is to list your monthly operating expenses. You have to know your numbers. That's your rent, your tools, your ads, your salaries if you have them, right? All of these expenses, right? Whatever they are, list them, write them out. Then look at your bank account. If you don't have enough to cover these operating expenses, then you don't pay yourself yet. It's really that simple, because founder pay only starts once business bills are secure. But I have something that's going to help you with this. And it's called the 1-month buffer rule. And it's that you always leave at least, key here, at least 1 month of expenses in the business. So if OPEX, that's operating expenses, equals $20,000, then you keep $20,000 in the bank account, at least. This protects you from at least 1 bad month. And above that, congratulations, you have money available for reinvestment or for your pay. All right, now let's see what's left for you. What's left for you is your cash minus your business bills minus your buffer, right? That equals your check. So an example is $60,000 in the bank, $20,000 in bills, $20,000 in buffer. That's $20,000 available to pay yourself using the 1 buffer rule. And that 20K is split between founder pay and potentially scaling the business. That's a choice you have to decide, but we'll talk about that a little bit later. So here's an example, just an example from one of my businesses, right? Here we have what's in the bank account. Here we have the operating expenses to run that business per month. I use an operating capital of 1.5 months, which leaves me with $219,000 to pay myself for the month. All right. And that's using the 1 buffer rule of at least 1 month operating expenses. The rest you get to keep. So how do you actually take the money out of the business? What are the best ways to do it? Let's dive in. There are 3 ways to pay yourself. One is the owner's draw, one is distributions, and one is salary. Okay. Let's look at the owner's draw. Owner's draw is simple, right? It's you transfer money from your business to yourself. All right. From the business bank account to your personal bank account. That's all it is. And this is common in sole proprietorships, partnerships, and LLCs. Unless the LLC elects to be taxed as a corporation, which we'll get to. Then there's no payroll needed. You just move the cash. Wire transfer, ACH transfer, however you like. Now, the tax effect on this is that the drawer itself isn't taxable when taken, but instead the owner pays income tax and self-employment tax on the business's net profit. And that's whether you take the profit out or not, right? You need to know that this is tax on the net profit of the business. All right, let's look at distributions. A distribution is just an official profit payout to the owner, right? This is used by LLCs, partnerships, based on your operating agreement and also used by corporations, right? S-corps take distributions, C-corps dividends. And you're paid based on your ownership percentage, right? So if you're a single member, say LLC, well, it's only you, right? So you get 100%. If you're a multi-member LLC, maybe you have equal splits, different splits, so on and so forth. And this is usually done quarterly or annually, right? Sometimes monthly. And S-corp distributions skip self-employment tax. All right, C-corp dividends face double taxation. You got the corporate tax and then the shareholder tax. All right, let's talk about salaries, also called payroll. Right, salary is simply a steady paycheck run through payroll. Right, if you ever had a job before, you know how this goes. All right, it's a fixed amount paid bi-weekly or monthly with taxes withheld automatically. Okay. Now, a salary is required for LLCs taxed as a corporation and if you're a C-corp founder. Now, this salary is subject to income tax, subject to payroll taxes, and the company also pays the employer portion as well. Okay. Moving on to choosing your payment type. You choose your payment type based on the entity that you are, right? The entity type decides the cleanest method. If you're a sole proprietorship or LLC, you do a draw. Do not do a salary, okay? It's just wrong. It'll lead to payroll tax headaches and nightmares. If you're a sole proprietorship or an LLC not taxed as an S-corp, then take a draw. If you're an S-corp, you're going to do a reasonable salary plus distributions. If you're a C-corp, yep, salary and sometimes dividends, right? And this is a quick tad bit. When do you move from an LLC not taxed as a corporation to an LLC, say, taxed as an S-corp? Well, that's after $60,000 in consistent net profit, right? Anything under 60,000, you're just going to be overpaying for the complexity and the ROI is not there. Okay. Step 3, how much to take. You want to start small and test the stability of your business before you start taking out just chunks and tons of money, right? You want to begin light and prove that the revenue actually holds. So your first payment, this is just an example, maybe $500 to $1,000 a month, regardless, right, of what your business brings in. Once again, when you're starting, you need to test the stability of the business and the revenue and the profit. After 3 steady months, you can raise it a little bit. If income dips, you cut back fast. All right. And you want to raise it only after consistency. Don't raise the pay because you like to and you feel like it. And I think now is a good time. You raise it only if revenue is consistent for 3+ months. Or when you've grown the 1 month buffer, at least have that buffer in there. Now, when do you reinvest in the business versus when do you pay yourself, or when do you do a combination of both things? Because every dollar can go to you or to the business, so you need to choose wisely. Well, here's kind of how I like to look at it. If you're early stage, you want to lean toward reinvestment. All right. You want to put money into the business so you can scale that revenue, right? And see it consistent month over month. If you're mid-stage, you might want to do 50-50. You got some consistent revenues, but you still want to scale, right? At later stage, you pay yourself fairly and distribute the profits. Maybe you got it to a stable place. Maybe you don't want to scale right now, right? You can do that. But the goal with all of this is to not starve either side. All right, you want to grow the business, maybe. You want to pay yourself, definitely. But you don't want to starve either side. You need both. What that percentage split is will depend on you and how you want to run your business. Now, step number 4 is setting it up and how to set it up properly. Let's first look at the owner's draw. It's the easiest of them all. And it's easy if you separate the accounts, which you should. You should have a business bank account and a personal bank account. So here's the steps. You just transfer from your business account to your personal account. Do it on a set schedule if you can. You want to track in your books as that payment being an owner's draw. Pay your quarterly taxes, right? And reconcile a year end. That simple. Owner's draw, piece of cake. Next up, we have distribution setup steps. It's more formal than an owner's draw, but it's still straightforward. You want to close your books monthly, right? Or quarterly, however you depend to do it. You want to confirm your true profit. You want to check 1 month buffer, right? Check your buffer. Allocate by per ownership percentage, and then document approval and transfer the money over. All right, that's how you do a distribution. For salary, here are the steps. Only 6. Not complicated, but more involved, right? You got to pick a payroll software. You got to decide your gross salary. You need to register for your state accounts. You run the payroll in that payroll salary, biweekly, monthly. That payroll salary will withhold and remit taxes, and you simply just record the approval. That's it for the salary. Now, I want to talk to you about health and retirement. When you first start out, some people don't think about this at all. And the truth is that you don't want to overcomplicate it too early. When it comes to your health, take stipends or small plans once profits are steady. When it comes to your retirement, you want to use a solo 401k or a simple IRA. Those are retirement accounts for business owners once that net profit is consistent and stable, right? You want to add benefits only after it's consistent. Now, let's talk about the mistakes that I see founders make every day, but it's not going to be you, right? Let's look over some pitfalls to avoid. When it comes to your taxes, don't get caught slipping, okay? The IRS is not a big fan of unorganization and being late, okay? So set aside taxes before you pay yourself. The rule of thumb is 25 to 35% of your profit. You want to put away for taxes just in case. Your payroll, the software should withhold your taxes automatically if you're running payroll. Draws and distributions, you pay estimated quarterly taxes on that. So the easiest fix is simply to move a percentage into a tax account as soon as your cash arrives. Right? As soon as you have the profit, move it over to a tax account so you don't forget. I can't tell you the horror stories, right, of people making, it don't even matter the amount, millions, right? And forgetting about taxes. And when that tax bill hits, the shock, the awe, right, the horror begins. The next big mistake is starving the business. As we talked about earlier, you don't want to treat your company as a personal ATM. Now, we are in business to make money. At least I am, right? But you can't treat it like a personal ATM if you can't afford to. So pulling out too much leaves no cash for growth. Pulling irregularly confuses your accounting, right? Your books, right? And the fix to all of this is to set a modest and predictable pay schedule. And there you have it. That's how to pay yourself. If you have any other questions, leave them in the comments. But as always, my name is Karan, and I'll see you in the next video. So you may be surprised that mistake number 1 is having an LLC when you don't need one. Because despite an LLC being the most popular entity type, an LLC is not right for everyone. And here's why. The first downside to an LLC is the annual required state filings. Depending on the state that your LLC is incorporated in, you may be required to file an annual report called Statements of Information with your state. And the second downside to the LLC is the cost to form it and to maintain it. Now, I get it, right? Fees vary from state to state, but it may actually cost you to stay in good standing with your LLC every single year. You have initial fees, right? Like the LLC formation fees. You have annual renewal fees, tax preparation fees, and more. And look, I've seen many cases where the cost to maintain the LLC actually outweighs the profit that the business actually makes. Now, the third downside to having an LLC, and likely the most misunderstood downside to having an LLC, is that by simply having an LLC, you get no extra tax benefits when compared to a sole proprietorship, unless you are making over $50,000 in profit a year and are being taxed as an S-corp. So unless your business has a risk of being sued and your business has the potential to make over $50,000 in profit, then you may not need an LLC. But let's just assume, right, that your business needs the liability protection, and of course you plan to make more than enough in profits. You now have all the protection that you need for your business by having an LLC. Well, maybe, because most business owners that have an LLC make this next mistake that will leave them completely exposed. Here's how the mistake usually happens. Entrepreneur goes to form an LLC. Entrepreneur uses his or her home address as the principal office address. Entrepreneur lists his or her full name as the registered agent. And in a few days, the excited entrepreneur gets the confirmation that their LLC has been registered. And unfortunately, that entrepreneur just committed mistake number 2, which is using their home address as their business address. And you don't want to make this mistake, because when you do, a couple of things happen. First, it publicizes your home address. Anyone can Google your LLC and figure out exactly where you lay your head at night. And it also limits future flexibility, because every time you move, you now have to update your business address. And who wants to do that? Which sounds like a pain. And if you're like me, right, who has moved 3 times in 3 years, that can be a pain. So my suggestion to you would be to use a registered agent or a virtual address. This satisfies the legal requirement, right, when starting your LLC, but it also keeps your personal home safe, secure, and private. And having a registered agent that is not you isn't very expensive. And if you ask me, well worth it for the privacy and the protection. And on the plus side, you can also get all of your mail scanned, forwarded, and handled for you. So I've left a link in the description for a low cost but reputable registered agent service. And check them out before you form your LLC so that you can have privacy and protection. And if you already have an LLC but want that privacy and protection, they'll actually update that address for you free of charge. Now, this next mistake is such a pain to resolve that it's better for you to catch it before it even happens. Because after searching for the perfect name for her business, Jessica landed on Creative Media Productions. And after paying for a domain, a website, and marketing materials, Jessica not only found out that other people were using that exact name, but she also found out that one company actually had the name trademarked. Now Jessica has to start completely over with a rebrand, losing time that she can't get back and money that she can't afford to waste. And that's why mistake number 3 is choosing an unavailable LLC name. You see, common advice when picking a name for your LLC is to pick something that is memorable, unique, and representative of your brand. And while that is solid advice, it's easier said than done when there are millions of businesses created every single day. On top of that, it's a must that you avoid 4 big mistakes. The first is legal action, because trademark holders can sue you if your name infringes on their intellectual property, because defending yourself is costly even if you win. Number 2 is lost brand momentum, because rebranding means redoing all of your marketing collateral, assets, and materials. because starting from square one can mean losing all of your early work. And not to mention number 3, which is customer confusion, because similar names within regions or industries could mean that customers could mix up your company. And last but not least is the search engine challenges, because shared names dilute your SEO when it comes to finding you on search engines like Google and Bing. Well, you can avoid this mistake by thoroughly searching your state's business registry, trademark databases, domain databases, and name similarity before you start your LLC. So let's break that down even further. Check your state's business registry for active businesses with similar names or even the same name that you would like to use. Next, search the USPTO trademark database for the name that you want, and filter by location for registered marks in your state or local region. Next, verify website domain availability. If the .com of that name is taken, consider alternatives. And lastly, I would Google name variations. Look out for other similar names occupying that real estate on the search engines. In general, simply take the time to make sure that the name that you want for your LLC is unique and actually available to use. And I think that avoiding name disputes right now in the early stages is well worth it in the long run. Now, when you go to form your LLC, you're going to be asked to choose something called a NAICS code. Now, you could think of that NAICS code as an industry. The IRS, the SBA, and other US governments use the NAICS code to classify your business. For example, if the IRS believes that your tax return doesn't align with other businesses within that same NAICS code, they may flag your tax return for an audit. But there's more to NAICS codes than just tax returns, because traditional and alternative lenders use that code to determine the risk of lending to your business. So banks look at other companies within your same NAICS code and decide how they're doing and whether it's risky or not to lend to you. So be sure to avoid mistake number 4, which is choosing a high-risk NAICS code, because having a high-risk NAICS code hurts your business before you even get off the ground. The first way is you being denied for loans and funding. Why? Because banks shy away from lending to risky industries to minimize defaults. Because insurance companies charge higher premiums for volatile industries. Then we have exclusions from you being able to go out and get a government contract, because many cities and states prohibit RFPs from high-risk businesses. And then we have fewer payment processing options. High risk means higher merchant account fees, with some providers simply rejecting applications altogether because of the risk. So some examples of high risk industries include auto dealerships, bars and nightclubs, cannabis dispensaries, guns and ammunition stores, pawn shops, and real estate. These are the industries that have higher chances of fraud, loan defaults, and greater risk. On the other hand, you have industries with low risk NAICS codes like accounting services, educational services, and legal services. These are the industries that are tightly regulated and therefore have lower risk when it comes to fraud. And as a result, banks are more relaxed when lending to them. So when you go to register your LLC, pick a NAICS code that is low risk but also relevant to your business. Now, mistake number 5 is the absence of corporate governance. You see, eager entrepreneurs kind of race through LLC formation to start their business. I get it. But formalizing your internal structure is actually an important step. Without defined roles, procedures, and documentation, I promise you that chaos is right around the corner. Because without an operating agreement, debates over profit or voting rights have no clear guidelines. And without a registered agent, communication between members tend to break down. So proper corporate governance can prevent these issues by outlining Division of ownership. How many LLC shares exist and how many go to each member? Also, member roles and hierarchy. We're talking defined responsibilities, decision-making powers, and leadership structure. And what about those standard operating procedures, also known as SOPs? These can help with guidelines for meetings, contributions, profit allocation, bookkeeping, and more. And last but not least, we have processes for dispute resolution. These are going to be the systems that help you to resolve conflict as they arise.